let's think about the impact then on market sentiment of what we've heard about China, because on the one hand, tariffs, Canada, Mexico, gone away for a month at least, maybe longer, but tariffs on China will be imposed for now. So what, in terms of risk sentiment, do we take away from that?
Yeah, so I mean, this morning we're very much seeing kind of a reaction across the FX space in particular, where we're seeing emerging market currencies rebounding by and large, and we're seeing some of the group of 10 currencies, the major currencies, continuing to fall versus the dollar. So it's this interesting kind of sort of shift in risk sentiment whereby people are a little bit more optimistic than perhaps they were at this time yesterday, but that risk hasn't kind of gone away completely. We did see, CNH, which is the offshore version of the yuan, sort of going a little bit lower during sort of Asian trading, although I would note that it's now come back and is relatively flat on the day, which I think is particularly interesting. And let's remember, we don't actually have onshore Chinese markets open as yet, so we can't really see the impact of these tariffs on the Chinese markets themselves. So that's something we're going to have to wait till after Lunar New Year. But at the moment, it feels like we're seeing some stability. There's certainly some relief around the fact that Canadian and Mexican tariffs are not coming in yet.
Is the lesson from the last 24 hours that Trump's bark is worse than his bite?
Some might say that, but I think the worry is that the barking could eventually lead to a bite. And we just don't know when that might be or if that is actually going to come or not. So I think I've seen some commentary out there that there's sort of a risk that the market becomes complacent and that, this whole idea of tariffs as kind of a negotiating tactic becomes embedded in the market in such a way that when we do see kind of, some of the bluster and the threats, that's viewed as all it is. And then you could ultimately see those tariffs come in and the market has to really react very kind of like quickly and violently as a result of not having prepared. So I think people in the markets are really having to kind of get a sense of how do you actually hedge that? How do you hedge something that might not happen or might get called off at the last minute? And that volatility is really, really difficult for people to digest.
And what clues are we getting from Treasury markets at the moment, Rachel? Because on the one hand, you could have seen at the weekend, are we positioning for higher inflation environment because of tariffs, or are we positioning for a flight into the safety, the haven status of bonds? And we saw a bit of both of those at different ends of the Treasury curve, certainly in the early hours yesterday.
Yeah, and I thought that was really, really interesting and perhaps kind of under-discussed because there was so much going on in other markets. Because, the Treasury market's really been the focal point of kind of this idea of the Trump trade. Are we going to see sort of yields really pushing up as we see more supply, more inflation come in? And yesterday we saw kind of like an aspect of that, but we saw yields at the front end moving higher, so those short-end yields moving to reflect short-term inflation. But long-term yields, as you referenced, were actually coming lower, suggesting concerns about growth and the idea that interest rates would have to come lower in the long term. That is a stagflationary environment, and that's something that is very, very worrying if it were to continue.